Enviri Corporation, Q2 2026, they actually beat internal expectations for both their operating segments. But man, you look at the reported financials and it's a mess. So adjusted revenue hit 324 million, which is up 2% year over year.
Yeah, and adjusted diluted EPS was a loss of 63 cents. But then you see the GAAP EPS, and it printed an absolutely terrifying loss of $10.70.
Right, driven by this massive $207 million charge. And the stock was honestly all over the place right after the print as the market tried to digest that gap.
Exactly. But, despite that initial shock, management reaffirmed their full-year guidance. So they're looking at 170 to 180 million in adjusted EBITDA for Harsco Environmental, and a loss of 19 to 26 million for Harsco Rail.
Which, kind of feels like they're just ripping off a $207 million Band-Aid, like just taking this brutal one-time hit to stop a chronic financial bleed and essentially reset the balance sheet for you, the retail investor.
100%. It was a survival requirement, really, if you look at why they ripped that Band-Aid off. I mean, the Harsco Rail segment is just a massive disconnect.
Yeah, adjusted revenues there were totally flat at 58 million.
Right, and with an adjusted EBITDA loss of 5 million. So that $207 million charge is basically them exiting two incredibly toxic European engineer-to-order contracts, specifically with Deutsche Bahn and Network Rail.
Wait, so CEO Russell Hochman is just stepping away entirely?
Yeah, he made the strategic call to just, eliminate those future execution risks and cash outflows.
Because those ETO contracts, I mean, they're usually fixed price, right? So with supply chain chaos and massive inflation, they're just eating the difference.
Exactly. They were bleeding cash every single day they kept working on them. So walking away, even at a $200 million loss, it stops the hemorrhage immediately.
Makes sense. And that really contrasts with their environmental segment, which is, kind of the bright spot here.
Oh, totally. Revenues there rose 3% to 266 million.
Yeah. And
adjusted EBITDA jumped 15% to 46 million.
Mm-hmm.
Margins even expanded 170 basis points to 17.2%.
Okay, but I have to push back a little here. Are those margin expansions actually real, or is it just an accounting mirage because they shed dead weight?
I mean, it's a completely fair question, especially since Clean Earth is officially off the books as discontinued operations.
Right, plus ditching those toxic rail contracts.
Yeah, but the data shows the growth is actually organic.
Mm.
It's being driven by higher services pricing, actual volume increases in their eco products, and internal cost out initiatives.
Wow, so they're actually running hotter on their own merit.
They are, and that efficiency matters because of the liquidity situation. You'd think that massive exit charge would crush them.
Yeah. Do they even have the cash to absorb those rail exit obligations without, taking on new expensive debt?
They do. With their new capital structure, net leverage is actually down to a really comfortable 1.9 times.
Oh, wow. Really?
Yeah. So they have the liquidity to absorb the hit organically. No expensive new debt required to cover the Band-Aid.
So they've cleared the deck. The toxic fixed-price contracts are gone, leverage is manageable, and the core environmental segment is genuinely growing.
Exactly, which leaves you with a critical question to mull over. With those legacy contract risks finally excised, the pressure is entirely on that core environmental segment. Can they prove they can drive sustainable profitability in a subdued macro environment?
That is the real test. Follow the show for your daily earnings coverage.